out there in Think Tank Land? It's Brian, one half of the Think Tank guys here, and I have another episode of our 52 ways to put our policy to work project. And in this one, this is totally clickbait. Clickbait. And if you clicked it, this is what you're looking for. This is what's baity about it. Designing a tax-free retirement. I gotta tell you, if you're fully successful at saving money and investing money prudently and creating a retirement where you're comfortable, you have checks coming in, they're dependable checks, and you have other money to invest and you're creating a legacy, you're not going to be fully tax-free. You're not. It's virtually impossible. And you can ask me, you can ask any CPA. I'm not a CPA, by the way, but we're going to talk some taxes and you can validate this stuff with your CPA. But there is an approach you can take to being more thoughtful about the way taxes will impact your retirement. And I think that's extremely important. And in today's talk, what we're going to do is we're going to talk about 3 different buckets that folks save into, and then more importantly, how those buckets impact taxes and your tax rates in the future. The taxability of your dollars in the future, how much more of your Social Security, whether it's around or not, becomes taxable, how many of your other dollars start getting hit at higher tax rates. If you don't understand how this is marginal tax rates down here, and this is the current married marginal tax rates. If you don't understand how those work, you might want to talk to your CPA the next time that you do your taxes and start thinking about proactive tax planning as opposed to reactive after the fact tax planning. Because in a reactive state, that's where we run into a lot of problems I'm about to describe in retirement, because we think we're saving taxes when actually we're deferring them. And that's what we have effectively, 3 main buckets from a tax perspective of where we're holding our money. We have taxable accounts, bank accounts that might earn interest, non-qualified accounts, things like that. Taxable accounts. We have tax-free accounts. Roth IRAs, Roth 401ks are a form of that. Our whole life policies and the way we can use them fall into that bucket. Municipal bonds are another way to get some tax benefits like that. But tax-free accounts, primarily the Roth and the policy fall in there. And then we have our tax-deferred bucket, which is like our traditional 401k or 401k, our traditional IRA. Most of the deferred methods that are pretty much the mainstream to save for retirement. The problem is, and the reason why I put it in red here, is that in the future, when we're taking income in retirement, whether that be from Social Security or pension, that income goes into our tax rate calculation, starts to fill up this cylinder, and depending on how strong that income is, we find ourselves at such and such a tax rate, right? Like in this example, like maybe 22% tax rate at the federal level for any dollars that are coming in. The problem that we have when we only save into our company-sponsored 401k, traditional IRA, we follow that mantra of just kick the can down the road, defer, 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 defer. Most people think they're saving taxes, but they're literally just deferring them into the future. And the problem is, and I experience this all the time with clients, the folks that are in their 60s and 70s, especially the folks that have acquired a sizable bucket here, a lot of folks end up finding themselves top heavy there, meaning they have 90+% of their wealth in a fully taxable environment. So what ends up happening is they want to go on vacation, they want to fix the house, they want to buy a condo, they want to buy a car cash, whether that's the right thing to do or not. They want to gift some significant money to their children, but all of their money's in this bucket. Well, the problem that causes is that when that money gets pulled out, it gets dumped directly on top of the dollars down here and possibly pushes them into higher tax brackets. And that's a significant problem and causes some adjustments to the thought process. Here's an environment where maybe they were successful at investing. Maybe they just lucked out with the market. Maybe they had a strong paying job and tucked a lot of it away into the IRA. But now they actually literally can't touch it without Uncle Sam getting a sizable chunk. And if you keep tabs on the way that our country spends, we can only see that it's getting hungrier and hungrier from a tax perspective. And there's much smarter minds out there, smarter than me, that agree to that. And that's where these rates, we have no control over those, and they can possibly go up, and indicators are there that they're most likely be up in the future. So what we're doing is we're deferring $1 today to be taxed in the future at a date at an amount we have no idea what that's going to be. How do we solve that? Well, effectively, I love that word, effectively. If we start, and those of you who have policies already, you're doing this. Those of you that talk to Eric or I about utilizing Roth IRAs alongside your policies, you're putting money in this bucket, the tax-free bucket. And what ends up happening in the future is when you pull money out of that bucket, it just goes right to your pocket. It doesn't get thrown into this taxable mix here. And that's how you can start to design a tax-free retirement. It's not going to be fully tax-free, but that's how you can start to design a strategy towards using dollars tax-free in your retirement. I'm sure, hopefully you got something out of that. And listen, more importantly, if you have any questions about this, ask Eric or I. And in the meantime, keep building your wealth. Keep thinking critically about how to manage money in your world. And of course, until next time, see you later.